Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Albemarle Corporation, ticker symbol ALB. Albemarle has been having quite a good run over the past year, in stark contrast to a lot of other businesses in the market. We're looking at them today because they are up compared to the overall down market, and because the business is a dividend aristocrat. They have consecutively increased their dividend payments for each of the past 28 years, which puts them in very good standing and gives their dividend history quite a good track record. Albemarle Corporation is up 29% over the past year. Currently, their stock price is trading for $276.80 per share. Over 3 years, they're up at a rate of 61% compounded annually. Their stock price is up nearly 5 times over 3 years. That's been a great return. Over 5 years, their returns are a little more down to earth. They've returned 15% annually. Even that is very good, and that's beating the overall market during this time. Over 10 years, they've returned about 18% compounded annually. Again, great here. And over the past 17 and a half years, going back prior to the global financial crisis, Albemarle has returned 17% compounded annually, crushing the market over this time frame. And keep in mind that this is not including the dividends that the company pays out. Although currently Albemarle only has a dividend yield of 0.56%. That's about a third of the dividend yield that an S&P 500 index would be paying out at this point. So Albemarle is about $30 under their 52-week high. They're up quite a bit from their 52-week low. A little over 2% of their shares outstanding are currently sold short, and they are a good-sized business. They have a $32 billion market cap. So for some background about the business, Albemarle is the world's largest lithium producer. Their outlook for robust lithium demand is predicated upon increased demand for electric vehicle batteries. Albemarle produces lithium from its salt brine deposits in Chile and the United States, and its hard rock joint venture mines in Australia. Albemarle is also a global leader in the production of bromine used in flame retardants. The company is also a major producer of oil refining catalysts. So they operate in the specialty chemicals industry, and the company serves the energy storage, petroleum refining, consumer electronics, construction, automotive, lubricants, pharmaceuticals, and crop production markets. Albemarle Corporation was founded in 1887 and is headquartered in Charlotte, North Carolina. For our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Albemarle based off of their business fundamentals. So this analysis is going to continue to evolve and improve over time. It's a work in progress, and it's an opportunity to learn in public. So with that said, let's get right into our analysis today. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. The reasons for this are that the average publicly listed business earns about a 7% return on capital, so by asking for 14% here, we can build in some potential margin of safety for ourselves based off the overall quality of the business being at least twice as good as average. And over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are captured here by return on capital. So Albemarle's return on capital has been decreasing over this time. They hit mid-single-digit returns in 2020, and those slightly increased in fiscal 2021. Over the last 12 months, their returns on capital are back to about 10%, so that's better here. However, averaged out, Albemarle is just returning 9% returns on capital. So while that is slightly better than average, that's below that 14% threshold we were looking for. And this is going to be an X here to start off on metric number 1. Next up, metric number 2, here we're taking a high-level overview of the cash coming into the business. We want to see revenue, net income, and free cash flow growth over the past 5 years. This metric is all or nothing in nature, meaning that either all 3 of these numbers are going to be up for a check, or if even one of them is down, this entire metric will be an X. We've seen their revenues increase slightly, and we've also seen their earnings up over this time. However, due to significant CapEx needs and reinvestment back into the business, their free cash flows are down over this time. So this is going to be an X here on metric number 2, although given their high CapEx and their reinvestment back to fuel their growth as the world's largest lithium producer, especially with rising trends in electrification across the board in power storage for both the electric grid and for electric vehicles. This potentially is not as bad as it seems on the surface here. Anyways, we are 0 for 2 to start off on Albemarle so far. Our third metric is going to be building off of the previous metric, But here we're taking the perspective of an individual shareholder in the business by looking at the company on a per share basis. So we want their earnings per share to have increased over the last 5 years. This is indeed the case. Their earnings per share have just about doubled over this time as their earnings are up. One thing to note is that the business has diluted shareholders by just a little bit here. So their earnings per share are not up at the same rate that their earnings are up. Their earnings are increasing a little bit faster. So Albemarle has diluted existing shareholders by about 4.5%. While this isn't terrible dilution by any stretch of the imagination, we don't want to see businesses diluting existing shareholders because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business issues new shares and dilutes existing shareholders, they're decreasing your ownership percentage of the business, which is ultimately going to decrease the percentage of the business's profits that you're entitled to as a shareholder. So even though the company has grown their profits over this time, if you had been a shareholder in the business for the past 5 years, the overall profits you've received from the business are up. However, your percentage of the business's profits are down by 4.5% here. So again, not terrible by any stretch of the imagination, but not perfectly ideal here. Either way, this is going to be our first check today on metric number 3. Metric number 4 is going to be very similar. Here we're looking for 5-year free cash flow per share growth. Again, because of their high need for CapEx reinvested back into the business, their cash flows have been down over the last 5 years. They've been reinvesting large amounts of CapEx back into the company for all 5 of these years. So this means that metric number 4 is going to be an X. Over multi-decade periods, we want a company's earnings and cash flows to be roughly the same. Huge discrepancies here could either be caused by what we're seeing in terms of reinvestment, potentially some other industry dynamics, or in more dubious cases, by either aggressive accounting or potentially even fraud. We identified that this 5-year discrepancy, while it's not on that same time frame, is largely caused by their reinvestment with large amounts of CapEx in the business. So not overly worried here. One thing to note is that generally it's relatively easy for a company to increase their per share metrics if they're doing so at the cost of their returns on capital. So it is good to see that although Albemarle has not been producing extraordinary returns on capital, that their returns on capital roughly balanced out are faring better than average. So they've been investing more money into the business recently at above average returns. If they're able to keep doing that and keep getting good returns on their capital and keep reinvesting in the company, that's the textbook example of creating shareholder value long term. To put this succinctly, it's looking like their cash flows are down for the right reasons here. Through our first 4 metrics, we are 1 for 4. So typically for metric number 5, we would want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that the company has generated over the past 5 years. However, in this case, because of their CapEx, we're going to be comparing their cash from operations as a better proxy here to not penalize this company for reinvesting back into their business at above average rates of return. At the end of last year, Albemarle had $2 billion of debt left over after subtracting all of their cash. Currently, they have $2.6 billion of net debt. And over the last 5 years, they've generated $2.7 billion of cash from operations. So this is going to be a check here on metric number 5. Although, again, we're not looking at their cash flows like we normally would. So technically, this cash from operations wouldn't be able to directly go down to paying off their debt here. And it's not cash flow, but the business is generating cash from their operations. One thing that could potentially be concerning here is that relative to their net incomes, the company had a huge change in other net operating assets. So determining what that change was and understanding that in more depth, given the fact that that was almost $750 million here, will help get a better perspective of their cash from operations. But with that change, over the last 12 months, they've only generated $19 million of cash from operations, which is significantly down from what they generated in 2019 and 2020. So that is something you would want to do more digging into to learn more about that, to really understand what's going on in this business. Then finally, the big metric of them all, metric number 6. Typically, we want their average free cash flows to total enterprise value to give us a yield that's above 5%. Here, again, because of their reinvestment, we're going to be taking the average amount of cash from operations that they've generated and dividing that by their enterprise value to get us a yield here. This will give us a better proxy for the business in this particular case. However, in the vast majority of cases, free cash flow is going to be the better number here. Free cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until judgment day, discounted back by some appropriate rate, is ultimately what that business is going to be worth. A company can use free cash flows to reinvest back into the business, make acquisitions, pay down debt, pay dividends, or buy back shares. We learned that Albemarle has produced $2.7 billion of cash from operations in the last 5 years, which means that in an average year, they're producing $540 million of cash from operations. Currently, they have a total enterprise value of $35 billion. We're using enterprise value here rather than the company's market cap because enterprise value is going to give us a more accurate economic picture of the business compared to market cap alone, because enterprise value is going to be taking into account both their market cap and their net debt position. This will give us a more realistic picture as if the company were a private business. So when we divide their average cash from operations of $540 million by their $35 billion total enterprise value, that is only going to give us an average cash from operations to enterprise value yield of 1.5%. That is less than half of the rate of the 10-year treasury currently, and that is well below that 5% mark we were looking for. So even using this proxy here, this is going to be an X on metric number 6. Again, because of that change reflected in their cash flow statement, the situation is looking even worse for their last 12 months of cash from operations here. So then finally, here we're looking at Albemarle's dividend profile. So Albemarle currently pays out a very small dividend yield. However, they've been increasing their dividend payments for each of the past 28 years, which makes them a dividend aristocrat. Given the company's high need for capex, we're seeing some contradiction in their capital allocation approach here. Given that the company has earned above average returns on capital and their high capex needs currently, it would likely be more advantageous for shareholders seeking long-term value creation by the business for these dividend payments to be retained by the company and reinvested as part of their capex. The business is not in a position currently where they're gushing out free cash flows, and these dividends would be money that couldn't be reinvested back into the business. So this is a big contradiction here, and given the pedigree of their track record, it would likely seem that they would want to continue growing their dividend into the future. From a capital allocation standpoint of what's the opportunity cost of these dividends, given that it's tax inefficient to pay out dividends in the first place, it's likely that a better capital allocation approach would serve long-term shareholders better here. So in summary, Albemarle Corporation checks the box on 2 out of 6 of our metrics. Currently, they're earning slightly above average returns on capital. Their revenues and earnings have increased in the past 5 years. However, their free cash flows are down due to high need for reinvestment back in the company. This is good given their slightly above average returns on capital, but how they're allocating their capital could definitely use some work, as it might be wrong, but it doesn't seem like the company is taking into account the cost of its capital, especially the opportunity costs of those capital, and it would likely serve shareholders better long term if they weren't as committed to their dividend increases going forward and would seek to reinvest that cash at above average rates into their business. So given their huge capex relative to the size of their business, we used their cash from operations as a proxy and found that the company would be utilizing reasonable amounts of debt there. However, even using that proxy, which again is only roughly accurate at best, it looks like the company at this total enterprise value is not giving us a potential margin of safety in their current price. So keep in mind that this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. And before considering any sort of investment decision, please consult with the properly licensed and registered financial and legal professionals. Instead, this analysis serves as a holistic and beginning understanding of Albemarle Corporation based off of their fundamentals, and it's really meant to help you determine whether it's worth your while to dig in and learn more about the company going forward. If you're interested in learning more about Albemarle, I would highly recommend diving into the company's 10Ks. You can read through those annual reports to get an understanding of the history and operational results of the business. Those reports will also detail potential risks that the company faces and will help you get a better sense of the environment that the company operates in, as well as get an understanding of the character and competence of the company's management. When you're done with that, I would also recommend reading through the company's 10Qs and reading through the transcripts of some of their recent quarterly earnings calls to get a more quarter-by-quarter perspective of the company going forward. So as a value investor, you ultimately want to do your own homework to understand a business as if you owned 100% of it, and you can truly know all of its ins and outs and know all of what's important and what's not important for that company. doing your own homework here to learn more is ultimately what's going to help you determine whether there's a true margin of safety or not in this company. So with that said, that's it for today's fundamental stock analysis of Albemarle Corporation. Again, they're a 28-year dividend aristocrat with the ticker symbol ALB. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Albemarle Corporation with me, and have a great day.